So let's discuss chapters 1 through 4. So before we dive into the problems that we'll be working on, let's first just talk about normal balances. Right? So normal balances are how an account increases. So we need to remember that assets, drawings, and expenses all increase with a debit, and liabilities, owner's capital, and revenue accounts all increase with a credit. And then to make it one of those accounts decrease, we do the opposite of its normal balance. So we need to know these normal balances for when we come up with journal entries, for when we prepare trial balances. So that little piece is going to be so important throughout all of accounting. So we have our first question here. It says, Emily Valley is a licensed dentist. During the first month of operation of her business, the following events and transactions occurred. We will need to journalize each transaction, then post all of those entries into T accounts, and then prepare a trial balance. So let's take a look at this first transaction. So our first transaction says that she invested $20,000 in her business. So we think about what accounts are being affected here. Well, the company is getting money, right? She's investing cash into her business. So we debit cash to make our cash increase. And then what's the other side of this transaction? Well, if she's investing in the business, her owner's capital is increasing as well. And capital increases with a credit, so we will credit our owner's capital. And for how much? That's where we get our $20,000. Now our second transaction, hired a secretary receptionist at a salary of $700 per week, payable monthly. So here, all we did was we hired someone. So they haven't done any work for us yet. We don't technically owe them any money yet, and we aren't paying them any money here. So all you did was you called someone up and said, hey, congratulations, you're hired. That's not a business transaction. And so we would not need an entry for hiring an employee. When we eventually pay this employee at the end of the month, that's when we will record it in our journal. Now here on April 2nd, paid office rent for the month of $1,100. So you're paying this month's rent. Since it's just for this month, we will debit rent expense and credit cash for $1,100. Now, if we were paying office rent for 6 months or for a year, then we would deal with prepaid rent. But since we are just paying the office rent for the month of April, we just consider that an expense here. Now on April 3rd, purchased dental supplies on account from Dazzle Company for $4,000. So we think about what accounts are being affected. Well, we are buying dental supplies and we are making this purchase on account. So our supplies, an asset account, has to increase, so we debit our supplies. And then how are we paying for these? On account. So we credit our accounts payable. And for how much? $4,000. Because we purchased supplies that were worth $4,000. Now on April 10th, performed dental services and billed insurance companies $5,100. So, here, when we think about which accounts are being affected, whenever we perform services, that's going to be service revenue, right? Whenever you see the phrase that you performed services, we can be thinking service revenue. So we can be thinking that we'll have to credit our service revenue to make our revenue increase. And are we getting paid right now? No, right? We're billing insurance companies. So whenever you bill someone or send an invoice, that's going to affect your accounts receivable. Accounts receivable is an asset, and it's increasing, so we will debit our accounts receivable, and we will credit service revenue. Because we need to show that these insurance companies owe us more money, right? They owe us an additional $5,100 now. And why do they owe us that money? Because we performed services. So we credit service revenue. Now here on April 11th, received $1,000 cash from Leah Smith for an implant. So Leah Smith is a customer, right? And she's paying us $1,000 right now on April 11th for work that we will do in the future. So whenever you receive money before you perform the work, that's going to be considered an unearned revenue, right? So this is an example of an unearned revenue. A few other examples: gift cards, right? A company will receive money before actually performing the work. Or airline tickets, right? If you buy an airline ticket, you typically buy that well before the flight itself. So those are unearned revenues. So in this entry, we are receiving cash. So our cash has to increase. And unearned service revenue is credited. Now, unearned service revenue is not a revenue account. Instead, it's a liability. But liabilities still increase with a credit, so we're okay there. And then how much? That's where our $1,000 comes into play. Now on April 20th, you received $2,100 for services performed, and you received it from Michael Santos. So another one of our customers paid us money for services. So what did we get? We got cash, right? So our cash has to be debited here to make it increase. And why did we get cash? Well, we got cash because we performed services, right? So our service revenue will be a credit. How much cash did we receive and how much in revenue did we earn? $2,100. So we will debit our cash $2,100 and credit service revenue $2,100. Now we have a couple more entries here. So on April 30th, you now finally paid that secretary receptionist that you hired back at the beginning of the month. So we are paying them for their 1 month of work, which came out to $2,800. So, how are we going to record this entry? Well, whenever you pay an employee their salary, we're dealing with a salaries expense, right? So a salaries expense or salaries and wages expense has to be debited. So we will debit that expense account. And then how are we paying them? Well, we're going to pay them with cash. Right? So we will credit our cash in this entry as well. And then our number in this entry, the amount that we need to debit our expense and credit our cash for, is $2,800. Now our final entry. You paid $2,400 to Dazzle for accounts payable due. So way back on April 3rd, we purchased supplies on account from Dazzle. And now we're going to pay part of what we owe them back. So if you are paying back someone that you owe, that's going to affect your accounts payable. And how's that going to be affected? Well, we need our accounts payable to decrease because we need to show that we don't owe them as much money anymore. So to decrease your accounts payable, you will debit that account. Because accounts payable is a liability, and liability accounts decrease with a debit. Now, our accounts payable is decreasing, but how did we get our accounts payable to decrease? By giving them cash, right? So our cash has to be credited in this entry as well. And for how much? That's the $2,400 that we paid to them, right? So our cash decreased by $2,400 and our accounts payable decreased by $2,400. So those are all of our journal entries for this problem. The next step is to post all of these entries into T accounts. So we have our 9 T accounts that we need for this problem. Right? We had cash, accounts receivable, supplies, accounts payable, unearned service revenue, owner's capital, service revenue, rent expense, and salaries expense. And you'll notice a few things here. You'll notice the order that I put them in. If we read across from top to bottom, it's assets, liabilities, capital, revenues, and expenses. That's the same order as your expanded accounting equation, right? So the reason I put them in this order is because this is going to help us when we need to prepare a trial balance in the final step of this problem. Now, before we start posting our entries into T accounts, the left side of a T account is for debits, and the right side is for credits. So we're going to reference all of our entries over on the left side of the screen and post those into these T accounts. So the first journal entry that we had was a debit to cash and a credit to owner's capital of $20,000. So we'll put that $20,000 over on the debit side of your cash T account, and the $20,000 on the credit side of your owner's capital T account. So now you've posted that entry into T accounts. So now we can just keep moving down the list. The next one, a debit to rent expense of $1,100 and a credit to cash of $1,100. So we'll put those into the rent expense and cash T account. Our third entry, a debit to supplies of $4,000 and a credit to accounts payable of $4,000, will look like that. We'll put the $4,000 on the debit side of supplies and the $4,000 on the credit side of accounts payable. Our next entry, a debit to accounts receivable of $5,100 and a credit to service revenue of $5,100. So we'll post those into our T accounts. Again, the left side of the T account is for debits and the right side is for credits. Now we move on to our next entry. We debited cash $1,000 and we credited unearned service revenue $1,000. So we'll post that entry into our T accounts. So just a few more journal entries now to post. We debited cash $2,100 and credited service revenue $2,100. So we post that into our T accounts. Then we debited salaries expense $2,800 and credited cash $2,800. And then our final entry was a debit to accounts payable of $2,400 and a credit to cash of $2,400. So you've posted all of your entries into T accounts. All right, so we have all of our entries in here. And what we need to do now is figure out the balance for each individual account. So how do we do this? Well, we can do it a few different ways, right? We can think back to our normal balances. And we can say, well, cash is an asset, and assets increase with debits and decrease with credits. So your $20,000, $1,000, and $2,100 over on the debit side for cash, those are all increases. And your 3 credits are all decreases. So you could add up all of your debits and subtract your credits. Another way to do it is add up your debits and add up your credits, subtract the two amounts, and the balance is on the side where there's more. Right? So if we add up our 3 debits for cash and add up our 3 credits for cash, subtract those two amounts, we'll see that there's a debit balance in cash of $16,800. So we put that clearly over on the debit side of our T account. Now, the next couple accounts, pretty easy to figure out their balances, right? Accounts receivable only had 1 entry in the T account, so that's its balance. Supplies, $4,000 is its balance, right? If there's not multiple entries into a T account, we can't do any math to figure out a new balance. Accounts payable, well, accounts payable had $4,000 on the credit side and $2,400 over on the debit side. Remember, liabilities increase with credits, so its balance is $1,600 over on the credit side. Got that by taking $4,000 minus $2,400. Now, unearned service revenue, only that 1 entry, so $1,000 as a credit balance. Owner's capital, only one entry, so its balance is $20,000. Now service revenue. Service revenue had 2 credits, right? Revenues increase with credits, so we add up those 2 credits, and they add to 7,200. So the balance in service revenue is 7,200. And then our 2 expense accounts just had one single entry. So rent expense has a debit balance of 1,100, and salaries expense has a debit balance of 2,800. So now that we have all of these balances, now we can prepare a trial balance. So a trial balance is going to start off with this: the company name, then it's going to say trial balance, and then it's going to have the date that you prepared it. Right? So this was all for just the month of April. So April 30th, 2020. Now, you'll notice it says accounts, debit, and credit. What we do in a trial balance is we list out all of our accounts and then their balances in either the debit or the credit column. So that's why we first figured out all of these balances here in our T accounts. Right? So if you don't have these T accounts written down, I would recommend taking a picture of the screen right now, and then that's going to help you as you prepare all of your trial balance. All right, so let's start creating our trial balance now. Now, we need to list out these accounts in a specific order. And that order is the order that I talked about a little bit earlier with the order that I listed out those T accounts in, right? It's going to go assets, liabilities, owner's capital, owner's drawings, revenues, and expenses. So that's the amounts of your, or that's the order of your accounting equation. So, we're going to start off with assets. Now, assets need to be listed in a specific order themselves. And that order is called your order of liquidity. So, your order of liquidity is how quickly can you turn it into cash, or how quickly you're going to use up that asset. So your most liquid asset will be cash. And we put the balance that we had for cash in the debit column because it was a debit balance. After cash, we have accounts receivable. Again, accounts receivables balance was in the debit column because it's an asset, right? After accounts receivable, we had supplies. So those were our 3 different assets. We had cash, accounts receivable, and supplies. And their 3 balances go in the debit column. After assets, we start listing out our liabilities. First one was accounts payable. Its balance of $1,600, you'll notice, is now over on the credit side, because a balance for a liability is a credit balance. After accounts payable is unearned service revenue. And that $1,000 balance is also on the credit side. So those were our two liabilities. After your liabilities comes owner's capital. And owner's capital had a credit balance of $20,000. Now, after your owner's capital would be your owner's drawings. But in this example, you didn't have any owner's drawings, so we don't need to include owner's drawings on this trial balance. So after your capital here, we're going to list out our revenue account. So service revenue had a credit balance of $7,200. After your revenue accounts come your expense accounts. Right? We had two different expense accounts. We had salaries expense of $2,800 and we had rent expense of $1,100. And you'll notice I listed out the expenses in order from greatest to least. So, you've listed out all of your accounts and their balances. That's step one of a trial balance. The next step is to add up all of your debits and add up all of your credits. Because we want to be able to show that your total debits equal your total credits. Right? Because we had a few different rules early on here in accounting. Your debits have to equal your credits, and your assets have to equal your liabilities plus owner's equity. Right? We had those two different rules that we had to follow here. So if we add up all of our debits and all of our credits, we will get $29,800 as your total debits and $29,800 as your total credits. So, if you prepare a trial balance and your total debits equal your total credits, you probably did everything right. You may have still messed up somewhere, but there's no point in going back and just double checking, right? However, if your debits don't equal your credits, something's wrong. I would first double check your math to just make sure that you didn't just add things up incorrectly. But after that, if that's all right, you then have to work your way backwards and figure out where that mistake might have been. So maybe it's in your T accounts, or maybe it's all the way back at your journal entries. So we prepare a trial balance like this to help us prepare financial statements, right? So you have those 4 financial statements. The first one that you prepare is your income statement. And on the income statement are your revenues and expenses to help you find your net income or net loss. So the income statement's number 1. After you prepare the income statement, then you can prepare your owner's equity statement. And we prepare that one second because we need the net income or the net loss from the income statement to help us prepare our owner's equity statement. So your owner's equity statement helps you figure out your ending owner's capital. And then you use that ending owner's capital amount on your balance sheet, the third financial statement that you'll prepare. And that balance sheet proves that your total assets equals your total liabilities plus owner's equity. And then after you prepare a balance sheet, then you prepare a statement of cash flows. So those are your 4 financial statements that you prepare. So question number 2. We need to use a trial balance to help us calculate net income or net loss, our total assets, our total liabilities, and our ending owner's capital. All right, so we have this trial balance for us. We have a bunch of different accounts here. The first step is to figure out our net income or net loss. Well, we were just talking about that with the income statement, right? You find that by taking your total revenues and subtracting out your total expenses. So revenues minus expenses get you your net income or net loss. So we need to go through this trial balance to figure out our total revenues. Well, on this trial balance, we had a service revenue of $64,000 and a rent revenue of $6,500. So we had those 2 revenue accounts, $64,000 in service revenue, $6,500 in rent revenue. So our total revenues will be $69,500. So we'll keep that in mind for when we figure out our net income or loss. Now we can figure out our expenses. So we take a look over at our adjusted trial balance and we see we had depreciation expense of $8,000. We had salaries and wages expense of $55,700. And we had utilities expense of $14,900. So we had those 3 expenses, $8,000, $55,700, and $14,900. So your total expenses, if you add up those 3 amounts, are $78,600. So red flags should be going off right now, right? Our total revenues, $69,500. Total expenses, $78,600. Well, since our total revenues are less than our total expenses, we're not going to have a net income, right? We're going to have a net loss. So, if we take our total revenues of $69,500 and we subtract out our total expenses of $78,600, we end up with a net loss of $9,100. So we lost money in this month, in this year. Now, we need to figure out our total assets. So we take a look over at our adjusted trial balance. And we know that assets are listed first, right? So we had cash is an asset, $9,840. Accounts receivable, that's an asset of $8,780. Equipment, that's a long-term asset, right? That falls under property, plant, and equipment. That's $15,900. We have one more. We have accumulated depreciation on that equipment. But that's not just a normal asset, that's a contra asset. So we're going to subtract out that $7,400 when we calculate our total assets here. So we will add together our $9,840 from cash, our $8,780 from accounts receivable, our $15,900 from the equipment, but then subtract out the $7,400 for your accumulated depreciation equipment, because that accumulated depreciation decreases the book value of that equipment. So, if you do that math, you'll end up with total assets of $27,120. Right? Your cash plus accounts receivable plus equipment minus your accumulated depreciation on that equipment. Now we can move on to total liabilities. So once again, we're taking a look over at our adjusted trial balance, and we need to figure out what are our liability accounts. Well, liabilities come after your assets, right? So we're looking at accounts payable. That's a liability, right? Because that's money that we are liable to pay to someone. You have one other liability, unearned rent revenue. Again, remember, these unearned revenue accounts are liabilities. They are not revenue accounts. So, those are our only two liabilities. So, your total liabilities will just be your accounts payable of $4,220 plus your unearned rent revenue of $1,800, which gives you a total liability amount of $6,020. So once we find our total liabilities, we can then figure out our ending owner's capital. So, a few different ways that we can go about this here. Let's make something that resembles a owner's equity statement, right? Where we start off with our beginning owner's capital. That's the $45,200 given to you on your adjusted trial balance. Then we subtract out this net loss of $9,100 that we've found earlier in this problem. And we subtract out the $16,000 in drawings that the adjusted trial balance shows us. So that's a total of $25,100 that we need to subtract out. Right? We need to subtract out $16,000 in drawings and $9,100 in a net loss. So if we take our beginning owner's capital of $45,200 and we subtract out $25,100, we end up with an ending owner's capital of $20,100. So that's one way that you could have found this. The other way is using your accounting equation. Right? Your total assets were $27,120 and your total liabilities were $6,020. So if you take your assets minus your liabilities, you would have ended up with $20,100. So those are the problems that we're going to be completing here during this review. I also just want to touch on a few things from chapters 3 and 4. Right? So chapter 3 discussed adjusting entries. Now, these adjusting entries will always have either a debit to an expense or a credit to a revenue. Right? So you need either a debit to an expense or a credit to a revenue. And the other account in that adjusting entry would be a balance sheet account. But make sure that that balance sheet account is not cash, because adjusting entries will never include cash. So that was really the big takeaway from chapter 3, right? Learning your adjusting entries. Chapter 4 focused on closing entries. So we had those 4 closing entries, right? First, you would close your revenues to income summary. Then your second one would be closing expenses to income summary. So you've closed revenues and expenses to income summary in your first 2 closing entries. And remember, when we are closing these accounts, we are zeroing out the balance, right? We want the ending balance to be 0. So step 1, we close our revenues to income summary. Step 2, close expenses to income summary. Step 3 is you close your income summary to owner's capital. So you zero out your income summary account. And then step 4, you close owner's drawings to owner's capital. So owner's capital is involved in these closing entries, but it is never closed itself. Owner's capital is a permanent account. So it's affected by your closing entries, but it is never closed. Your revenue accounts, your expense accounts, income summary, and owner's drawings, those are the 4 accounts that are closed. They're called temporary accounts. So after you close those accounts, their balances would be 0.